Hi, everyone. We've talked about the income statement with respect to revenues, and you know the matching principle from an earlier discussion is the principal guide in recognizing expenses. Now let's go to the balance sheet, and we'll walk down from the top. The first topic we'll talk about is accounting for cash. Now, it would seem that this would be one of the simpler things we have to account for. So let's take a look at it, and we'll see that there are still some pretty interesting complications. First of all, what is cash on the balance sheet? Logically, it includes coin and currency on hand. It also will include unencumbered balances in the banks, but it won't include compensating balances or other balances in financial institutions that are subject to material withdrawal restrictions. And it won't include cash funds that are earmarked and may be mandated by contract for non-current purposes. So the message here is that balances in banks are generally treated as cash, but not if they're subject to some material restriction in being used to meet current liabilities. Now, this is a critical idea. The current asset section of the balance sheet lists those liquid resources that we would presume will be available over the course of the year to meet our current liabilities. If we were to include in the cash account compensating balances, for example, that we're not able to withdraw, then we would mislead the financial statement reader about the amount of current asset actually available to meet our current liabilities. Now, for those of you who may not know, a compensating balance arrangement is an ingenious arrangement devised in the banking business many years ago. If the bank tells you that they will lend you a large amount of money, but that they'd feel a lot more comfortable about the lending and could live with the hard negotiated interest rate that you have agreed to, if you would keep a bank account with them, typically non-interest bearing, that would keep on hand an agreed amount of money. I mean, obviously, it's a rather effective way to drive up the actual rate of interest that you have to pay on the loan. But it does give the bank some measure of comfort that if you are late in making interest payments or payments of principal, that they have some money set aside for you to be able, for them to be able to draw on. Pension funds, an example of another cash fund that has your name on it. It's your account in a bank, perhaps, but it is by contract limited to be used to provide pensions for your employees. Now, most people, most companies will actually form a trust and will contribute to a pension trust these amounts. It gives the employees greater assurance that the monies will be there. But smaller businesses often do not use a trustee arrangement because of the added costs that might be involved. So what they might do is create a set of savings accounts or maybe even a single savings account in which they will pour their pension contributions. The account's still in the name of the company, but the funds by contract, by agreement with the employees, aren't usable. So those are not funds that we will list as cash because we'd mislead the financial statement reader. Now, on the other hand, we will treat as cash equivalents and therefore allow to be treated as cash some items that are short-term marketable securities, marketable investments, typically with very short maturities, very high-quality securities that a commercial bank will accept at face value, and then they will proceed to collect the amount. There may be a delay until the amounts are collected, but nonetheless, they are appropriately treated as cash on the balance sheet. So it's a little more complicated than I think you might have guessed, our desire being not to confuse or mislead the financial statement reader about what the dollar amount here might be. Now, with respect to balances that are in banks, we have a problem. Our accounting balance of cash in the bank and the bank's balance in our account may differ, and indeed both may be wrong. And the reason for that is that we know things about our bank balance that our bank doesn't know yet. And similarly, the bank knows some things that we don't know yet. The solution to this problem is that we're going to prepare a bank reconciliation. And a bank reconciliation will be our effort to combine everything we know about our bank account and everything the bank knows about our bank account, and to make sure that those numbers reconcile, and if required, make an adjusting entry to get the book balance of cash equal to the reconciled balance for cash. All right, so let's take a look at how we do this. Now, the first thing we have to do is we have to know what the bank balance is on the last day of our accounting period. And you know that banks send bank statements on probably 28 or 29 or 30-day cycles. And your bank account may cycle on the 17th of the month, so that on or about the 17th, you get your bank statement. Well, that doesn't do us a lot of good. And so what we have to do is we have to go to the bank, and we have to ask for a cutoff bank statement. And a cutoff bank statement is a statement that very clearly cuts the amount and measures the amount that we have in our account as of our year end. And if that's December 31, then the bank will give us a cutoff bank statement shortly after the 31st that will tell us what they believe our bank balance is on the 31st. And then we're able to do our reconciliation. This is what the format of a bank reconciliation looks like. It should, of course, have a heading. Now, again, this is not a financial statement that anybody else is going to see, but we're going to file these, and you want to be able to tell which reconciliation you're looking at with respect to the bank and with respect to the date. So our heading will be the name of the company, the title Bank Reconciliation for whatever bank, and then we will indicate, or if you've got more than one account with the bank, it could be a specific account in a bank, and then it would indicate the date, and the date would be the cutoff date on the bank cutoff statement for purposes of the reconciliation. Now, the format of the financial statement is that it's broken into two parts. We've got the bank part, and then we've got the book part. Typically, we start with the balance per bank, and this is the number that the bank tells us on our cutoff bank statement is the amount that we have in the bank. And then to that, we're going to add those things that we know about that the bank doesn't. And these things are primarily deposits in transit. So these are the amounts that at the end of business on the 31st of December, you put into the night depository on the bank, probably won't get recorded by the bank until the 3rd, perhaps the 4th of January. And then, so we'll add those because these are amounts that should properly be cash, but the bank doesn't show it. And then we're going to subtract outstanding checks. You remember that we disperse cash, we treat cash as having been dispersed on the date that we actually disperse the checks, not when they clear the bank. The consequence of that is that we know that we have these checks that have not yet cleared the bank. The bank has not yet accounted for them. So we're going to subtract the total of our outstanding checks. And those you can pick up by looking at the bank statement. You'll see which checks have cleared the bank, compare those with the checks that have been issued, and I'll know which ones have not yet cleared the bank but have been dispersed. When I get finished with these types of adjustments, I should have an adjusted bank balance. And this is the bank's balance adjusted for the things that we knew that they didn't. Now we're going to work on the books. We've got a balance per books. And the book balance will be the number that we show in our financial accounting records as cash associated with this bank or with this bank account. To that, we're going to add some things that we pick off the cutoff bank statement that the bank may have known about that we did not. If they have made any collections for us or if they're paying us interest on our accounts, then those are numbers that we will pick up and report in our adjustments to the balance per books. These are amounts that we may have suspected might be there, but without data, we haven't yet accounted for them. And then we're going to subtract from this bank fees or charges for services that the bank has performed. We will also subtract ugly NSF checks, checks that have bounced, that the bank knew about and we didn't know about yet because we've not received a notification. And so we'll subtract these items, and the result should be an adjusted book balance. So we've taken into consideration the things that the bank knew that we didn't, and we've taken into consideration the things that we knew that the bank didn't about this particular account. And the result should be an adjusted book balance here. And if the reconciliation has been prepared properly, and if there are no errors made by the bank or made by us in our accounting for cash, these two numbers should be the same. We should have reconciled our bank balances. Okay, one more step. Once I've done this reconciliation, then I will have identified some things that the bank knows that we don't. And that means I need to make accounting entries. And so in my adjusting journal entries, one of those adjusting journal entries should be an entry to either increase or decrease cash for these items, the things that the bank knew that we didn't. At that point, after we've posted these adjusting journal entries, then our adjusted book balance per reconciliation should equal our balance in our accounting records for this bank account. Okay, so we do the reconciliation, put a heading on it, file it, and use that as a basis for making the adjusting journal entry, increasing or decreasing cash, taking into consideration these items that the bank understands that we did not. Okay? Okay. Now we need to talk about internal controls. Let's define them first, and then I'll tell you a little bit about why we talk about it while we're talking about cash. We say that internal controls are all coordinate methods and measures that are designed to protect the assets of the firm and ensure the accounting reliability of the records of the firm. So, internal controls, everything that you could do to safeguard your assets and to ensure the reliability of the records associated with all of those assets. If you think about it, internal controls could be the use of a cash register rather than simply leaving the cash you've received from customers out on top of the counter. Locks on the door, burglar alarms, all of these things would constitute some of the simpler internal control devices. Labeling and numbering and identifying all of the property, plant, and equipment. Wherever you work, I'm sure if you look around, you're going to find a property sticker on things. The property sticker will help us identify what we have and quickly help us identify if we've lost something or if someone has stolen it. Now, we talk about internal controls in the context of cash, quite frankly, because cash is the ultimate internal control problem. By its nature, it's impossible to identify currency as being yours or mine other than by knowing who has possession. And it would be very easy for a business's cash to find its way out the back door with employees and out the front door with our customers if we don't have a strong system of internal controls in place. And so most textbooks that talk about internal controls in the first course in accounting will do it here in the context of cash. Now, the components of a system of internal controls are these. You want to establish a control environment. And a control environment means we want it understood that we are very serious about protecting our assets. We want to establish a tone at the top. We want to see management seriously interested in protecting those assets. We want a program of risk assessment. You need to actively engage everyone in the firm, or at least those that are critical in this process, in the process of assessing where we could lose resources, or where allowing anybody to have access to our accounting records could lead to a disaster. So we need a program of risk assessment. What do we need to do in each of these individual cases? And then we want to see control policies and procedures in place. We want to see locks on the doors. We want to see a burglar alarm system. We want to see all of the things that one might do to protect assets. In the case of cash, we want to make sure that we've got cash registers, which provide both a collection, safeguarding, and a recording. And that's very important for ensuring that the cash of the company remains the cash of the company as it should. We want information systems controls. We want to make sure that the only people who have access to the accounting system or to various parts of the accounting system are those people that we specifically identify as being trained and appropriate in that function. We don't want people who have access to both resources and the accounting for those resources. We don't want to see that. We want separation of duties. And we want a program of systematic monitoring. It's not enough that we have a system of internal controls. We have to make sure that it continues to function. And so we would expect that this would be the way this is done. Now, I can't overestimate the importance of internal controls. If an auditor steps into a firm to audit, and it doesn't matter how small or how big, and they find major problems with the system of internal controls, the auditor may simply choose to resign from the engagement. They may tell you, folks, you aren't auditable, and I don't want to be associated with your financial statements. So this is really important. It's so important that the Sarbanes-Oxley law requires that we make a report as auditors and that management make a report, and both of them are reports on internal controls. They have to be filed with the Securities Exchange Commission. So it's really important that we consider these issues. In cash, that means we want controls over cash receipts. Cash received by mail. You never let one person sit in a dark room all by themselves and open mail from customers and then record the amount of cash that's collected. That's a disaster waiting to happen. What you probably do is film 2 or more people, somebody from the accounting department opening it up, counting, and making an accounting record, and somebody else passing that cash balances on to somebody perhaps from the finance function, where they will check the count, make a note of the amount that they've collected, and then when they too leave the room, the accountant goes in one direction and the cash goes in the other, and we never allow them to be together again. Over-the-counter cash receipts provide for us the same kind of problem. Lots of issues with cash disbursements, lots of issues. Who can approve a cash disbursement? Who must sign the checks? What do we expect them to see before they will approve? And how many people must sign the check? We want to establish clear controls over cash disbursements. Now, the answer to all of these problems tend to fall into training issues, separation of duties, we've talked about them some, systems of authorization and documentary support, And then we want to see internal control motivated personnel policies. We want everybody to take their vacation. Standard internal control device. What happens when somebody's gone for 2 or 3 or 4 weeks tells us a lot about internal control problems that we may have experienced. That clerk of yours that hasn't taken a vacation in 15 years, when we force him or her to take that vacation, we may discover that they've been stealing us blind, and it's only by having somebody else step in and do that job that we realize the kinds of problems that we may be experiencing. And then we're going to expect frequent monitoring of elements. Internal auditors are created for this very purpose. Make sure the internal control system functions and functions as it's intended. All right. Cash on the balance sheet. Lots of interesting issues. That's about it for this issue. Look forward to hearing from you. Thanks a bunch.